immigration visas and also this new BNO route for immigrating to the UK. But we are not immigration experts, but we are here to talk about tax issues before you need to know before moving to the UK. I'm William Chen, the tax partner of the GrantThornton Hong Kong office, and with me here is Ling, our manager in our UK office, in London office.
Morning, everyone.
Sorry?
Good morning.
Yeah. Good afternoon here and good morning to you, Ling. Thanks for getting up early to talk to us on this webinar. To start with, I'm going to talk about the Hong Kong's issue, the tax issue you need to know when you leave Hong Kong, and then Ling will pick up from there to talk about what you need to do before you arrive in UK and the various tax issues you'll be facing when you are in the UK. If you have any questions during the webinar, please drop it in the chat box, or we'll try to answer at the end of the webinar, or at the end of the webinar there'll be time for you to raise your question as well. Please turn off your mic and also your video options, so it will allow for smoother transmission of this webinar. Okay, let's start with the Hong Kong tax issue. This is me. If you need to get hold of me, just send me an email or call me. I will try to answer as much your question. Okay, when you decide to leave Hong Kong, there's a few things you need to do. Fortunately, there's no exit charge in Hong Kong. So when you leave Hong Kong, we don't do a deemed disposal of all your assets. We don't have capital gain in Hong Kong, so that's why there's no need to do a deemed disposal of the asset and pay and the gain arising before you departure from Hong Kong. So that's because we don't tax capital gain in Hong Kong. So that's a fairly simple, straightforward. If you're an employee, you need to notify your employer and they need to file a IR56G because you are leaving Hong Kong permanently or leave Hong Kong for at least for more than 30 days going forward. So you need to do the tax clearance and they need to withhold your last month's salaries. And you need to get the tax return file, get tax clearance letter from the IRD, and they will release the money to you, and then you can leave town easily. So that's not too difficult. You just need to pop into the Inland Revenue Department with the form and fill out tax return, pay the tax, and they will give you a clearance letter. They normally do it fairly quickly. This is fairly painless exercise. Also, if you are leaving Hong Kong, you might consider withdraw all your employees' portion from the MPF. So that's tax-free, but you can only do it once in your lifetime. So you need to declare you are going to the UK. But I think at the moment you have to get permit for landing in the UK or have an immigration status before they will release you the NPF funds, not just because you have intention to go to UK and live there permanently. I think you have to get some sort of like visa status before they will entertain you to withdraw the NPF funds. But they also depends on the NPF service provider, they could take a few months to sort out. So that's something to consider. And then once you depart from Hong Kong, if you have rental income in Hong Kong, that will be taxable in Hong Kong because the property actually located in Hong Kong. So you still need to have consider the Hong Kong source income. You still need to pay tax in Hong Kong. Also, similarly for director's fee, because for director's fee, you will be deemed as holding an office in Hong Kong. So if you are a director of Hong Kong company, then I would advise you not to pay yourself a director fee and change it to employment income, employee as well. Because for employment income, if you're actually not working in Hong Kong, you spend less than 60 days in Hong Kong in a tax year, then potentially you can claim to be not taxable in Hong Kong. But of course, if your employment income or director's fee, you might have other issues. I'll talk about it later. But for director's fee, you definitely be taxed in Hong Kong. You pay the as your personal income, so you'll be definitely taxed in Hong Kong. Employment income, so it depends whether you claim the 60 days rules or not. If you only get the dividend and interest income, that's not taxable in Hong Kong. It's other investment income, capital gain, or other investment income, shares, other things in Hong Kong, it's not taxable in Hong Kong because it's tax-free anyway in Hong Kong. But like I say, if you are directors, if you're getting director's fee or employment income, you need to be careful that you do not end up with a permanent establishment or a CFC, a controlled foreign companies regulation. You need to fall foul of those because you have your employees working in the UK for your employer on a fairly long-term basis. And also, if you're directors, you're controlling the Hong Kong company while you're in the UK, you might fall foul of the CFC rules and deem the Hong Kong company to be tax resident in UK. So that's two things you need to be careful. So you're still drawing income from your company, whether you own it or not, or from your employer. You still need to be careful whether you end up with a PE, or if you own your company, you get a director's fee or employment income. Whether you are actually deemed to be running that company from the UK, you will have a fall foul of the CFC rules in the UK. I think Ling will pick up that hopefully. And source of fund, when you actually immigrate to the UK, you might bring money into the UK. Fortunately, the UK is not really that fuss about the source of fund. That's my understanding. You don't need to do issue a tax clearance report in certain jurisdictions. Like we have dealt with, like you need to get your tax advisor to issue you with a due diligence report, a health check report that say the money you're bringing in for the investment, say 5 million or so, 2 million or so that you're actually bringing in and investing in that country. Those funds are actually have tax being clear in where it came about. So I've personally dealt with a few for the New Zealand, Australian immigration cases. They need the tax advisor to issue a tax health check report. Those monies have been free of, like they have already paid tax and full compliance with tax in the country where the money actually came from. And then you need to issue that to the immigration people in the country where you intend to land. So, but my understanding, UK is not a fuss about it, but who knows what rules are coming next. So, like I say, the Hong Kong one Hong Kong tax issues seem to be fairly easy because we don't tax on most things. Like we don't tax on capital gains, dividend, interest income. So unless it's Hong Kong source income, then otherwise we're not taxed in Hong Kong at all. But like I say, you need to be careful if you generate income while you are in the UK. So with that, I'll leave it to Ling to talk about the UK tax issue when you before you get into UK, or when you land, after you land in the UK, how you mitigate the tax on your income arising from either UK or from Hong Kong. Ling, over to you.
Thanks very much, William. Just going to share my screen. Good afternoon, everyone. Thank you very much for attending. William, can you just confirm you can see my screen? Oh, William, I think you're on mute, but...
Oh, yeah, sorry, I can see it. Yeah, definitely.
Okay.
It's fine with me. Yeah.
Okay, excellent. Right. So, hello, everyone. My name's Ling. I'm a tax manager in GTUK, and I deal with individuals, and I also deal quite a lot with internationally mobile clients, and a lot of clients are now looking to relocate to the UK from both Hong Kong, mainland China, Singapore, and Southeast Asia as well. So my team, we're known as Grant Thornton Private, and as it says there, our clients are internationally mobile high net worth individuals. We help individuals, we help their families, and we also have a strong presence in being able to advise entrepreneurs as well. So entrepreneurs from outside the UK who want to invest in the UK, and entrepreneurs when they come to the UK, we can help advise them as well. And the typical kind of advice we do is pre-arrival or pre-departure planning, so making sure all the tax things are dealt with before they come to the UK, and if they want to leave the UK as well. We often set up a lot of tax efficient structures. We help individuals, we can set up companies, trusts and partnerships as well. And where an individual wants to stay in the UK longer term, we also help with inheritance tax as well as succession planning. So in terms of Grant Thornton, we are part of Grant Thornton International, and we're present in over 135 countries around the world. We do have offices in mainland China and Hong Kong. So William, in the UK, I'm part of a group known as the China British Business Group, and this effectively is like a China desk. We're formed specifically to help with Chinese clients. I can speak quite basic Mandarin, but there are other individuals on the desk who can support me, who are native speakers, both in Mandarin and Cantonese as well. So I'd like to start just with a really typical case to give you an idea of what kind of tax issues arise and what the benefit of having the right tax planning is. So here we have a high net worth individual that come into the UK. This may be on the new BNO visa or the more traditional route on the investor visa. So this individual, they have 5 million plus sterling of worldwide assets, and this is pretty much all invested overseas. If they get a reasonable return, they're looking at 100 to 200,000 of overseas income and some capital gains every year as well. So when these individuals want to come to the UK, they typically will remit, so bring large sums of funds to the UK to buy their own property, perhaps to buy investment property, and then also to fund their lifestyle or to look at UK investments as well. Or if they're coming on the UK investor visa, they'll need to remit at least 2 million up to 10 million, depending on the kind of visa they want. So let's put our tax hats on and think about why the tax planning here is important. Any UK investments or any UK source income and gains are subject to UK tax. So out of 5 million at the moment, overseas income and gains is normally taxable in the UK, but with the right tax planning, we can reduce that pretty much to nil. So that means you can have, with the right tax planning, you can have a significant saving of up to 45% tax if it's income and up to 28% tax if it's capital gains. When you're coming to the UK, depending on how you're taxed, potentially there is tax on bringing funds to the UK. And in the worst case scenario, if you bring what's known as chargeable interest or income on funds remitted to the UK, that can create a tax charge of 45% simply on bringing those funds to the UK. However, there is no UK tax charge if you bring funds known as clean capital. And a lot of our advice is centered around maximizing the amount of clean capital available to each client so they know what they can bring into the UK without needing to pay any tax. So for the rest of the webinar, I'm going to be talking about tax residence, domicile, and the remittance basis of taxation. We'll touch upon how to bring funds into the UK with the minimum amount of tax. We'll look at certain tax reliefs and tax efficient structures as well. And at the end, I'll have a case study which is a real client of mine, and it will touch upon quite a lot of the common questions and quite a lot of the common issues to show you why this tax planning is very important. So to start off with, this is a very complicated looking slide. I won't read all of it out, but the main point here is residence. When you are UK tax resident, you become subject to UK tax. However, when you're not UK tax resident, quite a lot of things are not subject to UK tax. As you can see here, there's 3 tests: an automatic overseas, an automatic UK test, and a sufficient ties test. We apply these 3 main tests. There are sub-tests within those 3 tests as well, and it's quite complicated, but the main point is we need to understand when an individual becomes UK tax resident. That may be for the whole tax year. So in the UK, our fiscal tax year begins at 6th of April and ends in the following 5th of April. They may be resident for the full tax year, or they may be resident partway through, so when they actually physically arrive in the UK. And why it's important to work out the position is to work out when that individual becomes subject to UK tax. Now, a lot of individuals that we provide tax planning to are non-domiciles. So what is this concept, this domicile thing? An individual's domicile is their connection to a country where they feel that this is their permanent home, their long-term home. This may be the place they reside in currently, or this may be somewhere that they intend to reside in the future. So it's very possible for an individual to be domiciled in a country that they do not live in. And those relocating to the UK, they typically, once they're in the UK and they are resident in the UK, they will be UK resident, but not UK domiciled. The only caveat here is they do become UK domiciled at the point they want to stay in the UK long term. And the domicile point here is important because if you are a non-domiciled individual for UK tax purposes, then you have available to you an alternative basis of taxation that can be very, very beneficial and save quite a lot of tax. So talking about that basis, here we are on this slide. I'll start with the arising basis. So the arising basis is the normal tax basis that someone who was born in the UK and lives in the UK is taxed upon. So what that means is if they are UK resident and UK domiciled, they're taxed on all their income and all their gains. So it doesn't matter if the income is from the UK or overseas, or the gains from the UK or overseas, they'll be taxable in the UK on everything. However, for a UK resident, but not UK domiciled individual, so a lot of high net worth individuals relocating to the UK will be in this category. On UK source income gains, they're taxed the same. They do need to pay tax on that. However, on all their overseas income and gains, if they elect to be taxed under the remittance basis, they do not need to pay tax on that. There's quite a few complicated rules surrounding us and caveats, but the basic position is they won't be taxed on it. This is obviously very, very beneficial. So that sounds a little bit too good to be true. So there are some drawbacks on being on the remittance basis of tax. So some small ones here is that when you're taxable on the remittance basis, you lose your access to a personal allowance or annual exemption. So this means that the first just over £10,000 of income in the UK normally is taxed at a 0% basis, but someone on the remittance basis can't claim that. And the annual exemption is a similar thing before capital gains. Now, for the first 7 years where an individual comes to the UK and is resident in the UK and they are non-dom, they can elect to be taxed on the remittance basis and they don't need to pay any charge. They simply lose those allowances. However, when they stay in the UK longer, so once they're in the UK for 8 consecutive years, or 13 consecutive years, they then need to pay a £30,000 charge per year or a £60,000 charge per year, simply for the ability to claim the remittance basis. So one of the important things here for us when we're advising our clients is to look at their worldwide sources of income and work out, is it beneficial to be on a remittance basis? Often it will be. However, if they need to pay a £30,000 charge per year or a £60,000 charge per year, is it the best basis for that tax year? And you claim it per tax year, and we can help with doing that. Now, at the very right-hand side, you can see that if you are UK tax resident for at least 15 of the previous 20 tax years, you become deemed domicile. What that means is even though you are still a non-UK domiciled individual by law, the UK will treat you as if you were deemed domicile in the UK, and that means you cannot then claim the remittance basis anymore. The other major drawback to claiming the remittance basis is the ability to bring funds into the UK. Once you're in the UK, if you imagine the typical client, they will have very little in the UK, so their UK tax liability will be minimal. However, in my very first example, the individual has 5 million invested overseas, creating overseas income. So if they're taxed on the remittance basis and they do not need to pay UK tax on that, then bringing those funds into UK would then create a tax charge. And so it's really important to do some tax planning around here to maximize the amount of funds that can be brought into UK without a tax charge. So as you can see from the slide here, if you bring chargeable income, that has a tax charge of up to 45%. For capital gains, that can be up to 28%. But for this clean capital, there is no tax charge. Often individuals who relocate to the UK, they need to remit significant funds to the UK. Investor visa, property, general lifestyle, general living, they need to bring funds to use in the UK. So what we do with our tax planning is to review the position and work out how much clean capital is available, and we will try to maximize that. So any clean capital funds that are brought to the UK, you can bring it in, you don't need to pay tax. And that's the real benefit here. We also help to structure the bank accounts of our clients correctly so that we know what bank accounts contain income, what bank accounts contain capital gains, and what bank accounts contain clean capital. It's really important to segregate anything out, because if any income or gains goes into a clean capital account, you can't just take it out again. It then becomes a mixed fund, which means if you bring a mixed fund into the UK, you will have some tax to pay, rather than no tax if it was just clean capital. And with our tax planning, we can create certainty. So if you bring funds to the UK, it will be at 0%, it could be up to 28% or up to 45%, but we will be able to tell the clients what those accounts are and what the basis of bringing those in would cause in terms of UK tax. A few more points on the remittance basis. So these are very typical scenarios that occur with our clients. If they have an overseas business, or if they have properties or assets overseas, what happens on the remittance basis? So if the business doesn't have a physical presence in the UK, so there's no permanent establishment, we potentially can reduce the UK tax on this to nil. We would need to review the current structure and see whether we would need to change the structure. However, if the business is based in Hong Kong or another country, there may be tax obligations in that country, but in the UK, not necessarily you would need to pay any tax. There's also the question about being centrally managed or controlled in the UK. So with an overseas company, there's a risk that if all the directors are in the UK, it may be brought into the UK tax net, regardless of the fact that it is not a UK resident company. Let's say in this case, it'll be a Hong Kong-based company. So we would need to examine that and see how best we get around that. Because obviously, if you have a very profitable business overseas and you're not paying any tax on the remittance basis, the last thing you want to do is create a UK company with that offshore company, and then all of a sudden you need to pay UK tax. So what if you sell your properties or capital assets overseas? Again, we can reduce the UK tax on this potentially to nil. We will need to have a look at the structure. We need to see whether you need to bring those funds in or not. And again, there may be tax obligations in that country itself. In terms of other useful tax points, UK is very well known for having investment opportunities, and there's a special relief called business investment relief. Under this relief, as long as the rules are met, you can bring in any funds to invest in the UK. So that means if you have funds that if you brought it in to use yourself, you may need to pay up to 45% on bringing those funds into the UK to use it yourself. However, if you brought those funds into UK to invest in certain businesses under this business investment relief, you do not need to pay tax on that, which can be very beneficial because obviously under this case, you would rather use the funds that you couldn't otherwise use in the UK to invest in UK businesses. And in terms of UK property, a lot of our clients really do like to have investment properties in the UK. They're very comfortable with it. If you hold an investment property and have rental income in the UK, you could be taxed at up to 45% on that. However, if you have an investment property in the UK and is held in a corporate structure, the tax rate can be reduced down to 19%. Also, capital gains tax, the tax on selling that UK asset, the UK property, is also lower in an offshore company as well. So when you're receiving rental income, it may be much more beneficial to hold it in a corporate structure instead of holding it directly as well. For individuals who stay in the UK much longer term, inheritance tax becomes something they really need to think about. So for those who don't know what inheritance tax is, if you pass away in the UK, then typically your estate, so all the assets you have, may be subject to UK IHT. If it is, then up to 40% of that will be subject to UK IHT. So, however, for UK resident non-UK domiciled individuals, it's only their UK assets will be subject to UK tax. Their overseas assets generally will be exempt. And what we can do is help mitigate and minimize any inheritance tax exposure by creating offshore structures to do so. For individuals who want to stay in the UK longer term, so at least 15 of the last 20 years, or perhaps they want to stay in the UK, very, very long term and perhaps forever. At this point, there's a risk that they lose their non-UK domicile status. And if they acquire UK domicile, then they become taxable for inheritance tax purposes, not just on the UK assets, but on the worldwide assets. So obviously this can be quite a big issue. What we can do in terms of tax planning is we can still protect those assets from UK inheritance tax by creating an offshore structure. This does need to be done before they acquire a domicile in the UK, and there's quite a lot of complex rules around this, but this is something that we can do for our clients if they do want to stay in the UK longer term. Often clients either want to stay in the UK longer term, or they stay for 5 to 10 years and then they're thinking about relocating elsewhere, to which we can help with the tax planning for them leaving the UK as well. So I'm going to come to 2 case studies which are clients of mine, and this should highlight the important things that come up and give you an idea of what we've been discussing, but in a real life scenario. So I've got a client, so we've anonymized him. He's Mr. X. He came to the UK in 2019, and we were introduced to the client before they came to the UK, and we were able to advise them before they physically come to the UK, which is the best time, because once you're already in the UK, it's quite hard to change anything at that point in time. So we start off by looking at Mr. X's residence. We examined his planned arrival dates. We looked and reviewed the overall UK potential residence position. And in the end, we helped the client come to the UK in February. Why in February? Because with the UK residence rules, we worked out that if Mr. X came to the UK in February, he would not actually become UK resident until the next April. So therefore, once he's in the UK, even though he's physically here, for UK tax purposes, he's not in the UK. So that allowed him to be in the UK, but gave us a bit more time to advise him and arrange his offshore affairs before he's technically UK resident for tax purposes. In terms of domicile, because he was a high net worth individual, and because we were considering the remittance basis, we examined his overall position. Apologies, the slide is slightly off here, but when we looked at his domicile position, we have to look at his parents, we have to look at his grandparents to see where they were born, and we put together effectively a case, a folder. What that means is we examined the position and we found that Mr. X was not UK domiciled, and this is date stamped at that point in time, so in February 2019. What that means is in the future, if HMRC, which is the UK tax authorities, if HMRC look into the position and want to say that Mr. X is not non-domiciled, he is UK domiciled, and therefore he needs to pay more tax, then we have this piece of evidence back in 2019, before he came to the UK, or before he became UK resident, that shows that we examined the position. So that's a strong bit of evidence. And of course, if you're a non-domiciled individual, you can then be taxed on the remittance basis. So in terms of the remittance basis here, we then examined his offshore income and gains and worldwide assets and determined that the remittance basis is very much beneficial to Mr. X's personal circumstances. He had just under 10 million of worldwide assets, and quite a lot of those were generating income in Southeast Asia. And therefore, when he's in the UK, without having any UK cited assets, the only taxable income on him would be offshore. And under the remittance basis, we can then prevent that from being taxable in the UK. So we gave him a saving up to 45% on the income tax, the offshore income tax, and up to 28% on any offshore gains. In terms of remitting money to the UK, Mr. X wanted to buy at least a property to reside in himself. So what we had a look at is his offshore structures. We looked at all the funds available to him. We did a bit of forensic accounting on that, so we know what the different funds represent, whether it was income, dividends, whether it was gains, or whether it was a mixture of everything. We then analyzed this and then told him, okay, these bank accounts here, these are clean capital. Once you're in the UK, under the remittance basis, you don't need to pay tax on your offshore income and gains, but then we need to segregate that. We can't have those funds going into your clean capital. So we then helped him with his bank to segregate those funds going forward. What that means is there's minimal tax on him now, once he's in the UK and in the future on his offshore income and gains. He then remitted over £1 million to purchase the UK property, very nice house in southeast UK, and he also later on remitted several million ad hoc when he found some investment properties that he liked the look of. And so in terms of bringing those funds to the UK, worst case scenario, you're paying up to 45% tax on that, and we gave him a saving of up to 45% tax here. Now, Mr. X does have offshore businesses, and he does have offshore interests in businesses, and so we examined those structures. We planned and updated the structures where necessary so that UK tax is minimized, so that he doesn't need to pay any UK tax really on the remittance basis. And as mentioned earlier, it's really important to look at the offshore structure carefully, because you do not want to bring an offshore company into the scope of UK tax. Once that happens, then that becomes, in the UK tax authorities' eyes, it becomes a UK company. So you go from a position of you don't need to pay tax in the UK to now you need to pay tax in the UK on everything, which is obviously not ideal. If you do overlook that, then that is what happens. And one of the things that's important to look at as well is that if it's a small company, it can't be centrally managed or controlled in the UK. So if it's a company that Mr. X runs pretty much himself, then him being in UK becomes a problem that could create the UK tax resident company here. There are tax planning ways to get around that and to mitigate the tax there as well. But it's really important to look at this position if they do have significant offshore business interests. And in terms of property, well, offshore property income and gains doesn't need to be taxable in the UK under the remittance basis. We had a look at his offshore interest and determined we didn't need to make any changes here. It was already protected from UK tax, so that's great. In terms of the UK property that Mr. X wanted to have a look at to buy, to then rent out and hold for investment purposes, we then looked at this and looked at whether it would be better to hold it in the corporate structure, and we did so in the end. That gave him a tax saving up to 26% on the UK rental income. It's 26% because if Mr. X held it himself, the income is subject to tax at a maximum rate of 45%, but it was held in a company, it's only taxable at 19%, so that's a significant saving. Then we do need to look at the issue of how to get the funds out of that company to Mr. X. However, there are ways of doing this very tax efficiently as well, and certainly the tax burden will be lower than a maximum of 45%. So overall, in terms of the summary, we put Mr. X on remittance-based taxation. The majority of his worldwide income is not going to be taxable in the UK, so he has very little tax exposure. With the right planning, he doesn't need to pay any tax on bringing funds to the UK if we create enough clean capital for him. We lowered his UK tax exposure on the rental properties and rental income. So we've created a substantial tax saving on day one, in the first tax year, in the second tax year, and also going forward as well. And as I mentioned earlier, the longer you stay on the remittance basis, the more it may cost you to then claim the remittance basis, up to a maximum of £60,000 per year. So what we can do is review this on a yearly basis to see whether it is worth claiming the remittance basis for that year, or if they want to be on a rising basis just for that year. And we can review that on a year-on-year basis. So that's a great scenario for my client. Now this second scenario, Mr. Y, and again anonymized, this is a scenario which hopefully with the right tax planning is always avoidable. And this is to show you an example of a client I've dealt with where it was a really poor outcome, and that is because they did not get the right tax planning. So Mr. Y came to the UK in 2012. He wasn't fully aware of the UK tax rules. He found a local accountant. He was put under the remittance basis. And over the years between 2012 and 2020, he brought over about 4 million sterling to the UK and bought his own property and also bought other properties for investment purposes. And he also brought funds just to fund his lifestyle in the UK. He then became under inquiry from HMRC, the UK tax authorities, and the main question they wanted to know is the funds you brought into the UK, are these clean capital? Can you show us evidence that it is clean capital? The reason HMRC likely knew about the large amounts of funds brought to the UK is because Mr. Y came to the UK on an investor visa, so he's known to the authorities anyway. He also brought in significant amounts of funds to buy property, and that was in his own name. So this property would be registered, on the property database. So HMRC would know pretty much the funds he's brought into the UK, and at 4 million, that's quite substantial. Now, we were introduced to Mr. Y in 2019. We've been advising him since then, and we had to review the position to see what had happened and how to deal with HMRC at this point and resolve the position. So we had a look. Mr. Y was UK resident all the way back in 2012 and UK resident every year. And he's remitted 4 million. And what we need to have a look at is every single transaction of those 4 million funds to the UK, we need to examine to see if it came from clean capital, if it came from income, or it came from gains. So this is quite a time-intensive and laborious task. And we looked into it very carefully for him. So Mr. Y does have significant offshore income and gains. And when we looked at it, significant portions of the funds came from a mixed account. So that's an account that contains not just clean capital or income or gains, but at least 2 of those. And there's a lot of income in there. And from our overall analysis, we found that most of the 4 million brought to the UK, so at least half of it, would be matched to income. So that means 2 million funds are potentially taxable up to 45% on Mr. Y. Because he's brought in chargeable income while he's on the remittance basis. So one of the things we can think about here is it the right thing for him to be on the remittance basis? Because he's going to need to pay potentially a lot of tax here on the funds he's already brought into the UK. We had a look and he has very, very significant offshore interests. He's an ultra high net worth individual. And so even on this basis, it's still better for him to be on the remittance basis because he has a lot of offshore income that will be taxable and that will create a larger tax liability. So then we have a look and we work out how much of tax Mr. Y does need to pay. We then need to deal with HMRC and show them our calculations. We need to provide evidence of how we arrived at that. We need to provide evidence of the amounts transferred to Mr. Y offshore, which he then transferred to the UK. Also funds transferred to him from family members and from his companies, etc. We need to look at all of that. And in the end, we did resolve the position, but it was a very costly exercise. And I think the main point here is if the right pre-arrival tax planning was done in 2012, then Mr. Y may have been very similar to Mr. X in that this 4 million he's brought to the UK, he's had to pay quite a lot of tax now. But with the right tax planning, he could have potentially paid 0 tax on that. So this is why it's so important to get the tax right. So this is the last important slide, is the key takeaways. And essentially, the UK is very attractive right now. I do have quite a few inquiries from Hong Kong clients, Chinese clients, and also clients from the Singapore region who are looking, considering coming to the UK, relocating to the UK. The UK, as you can see, can be very, very tax efficient, and is very, very tax efficient, even looking at other countries around the world. As you can see, if you have very little UK cited assets, you may be taxable on pretty much nothing in the UK with the right tax planning. And so on that note, getting the right tax planning, getting the right pre-arrival tax planning is just so important here, because we can minimize the UK tax due on when they're in the UK. We can minimize the amount of tax due if they bring funds into the UK. So there's no unnecessary tax charges, and potentially the tax charges could be nil with the right tax planning. So that's the end of my slides. This is a quick disclaimer, and these are my contact details as well. If you have WeChat, you can scan that QR code, but I respond relatively quickly to WeChat, but probably better on the email. So do let me know if there are any questions, and I'm going to stay on the line for a little bit longer and answer any questions generally that you have for me. Thank you very much for your time.
Yes, thank you, Ling, for the really nice, good presentation. Fairly lots of things to consider. Since people are waiting for others to raise a question, I have a couple of questions for you about the clean capital, right? Is there a cutoff? Like, do I create those clean capital account before I arrive in the UK, or does it matter? Does it go back a few years? Because in Hong Kong, like, people move money in and out of different bank accounts, like, all mixed up.
Yeah, so that's a really good question. Thank you for that, William. Clean capital can only be created before you're UK resident. It may be able to create more clean capital if you then leave the UK. But if you come to UK and then just stay in the UK every year, you cannot create any more clean capital. So in terms of tax planning here, we would look at everything offshore. We would look at the bank accounts, and then we would work out what is clean capital. And the main point here is we need to segregate that going forward. So for instance, with Mr. X, we worked out what was clean capital, and then from that moment onwards, no other funds went into those accounts. So no standing orders, no income, no dividends went into that account anymore. We then help create mirror accounts so that we know these are funds before they came to UK, these are funds after they come to UK, and we designate, and the client's very much aware that, account A, that's the clean capital account, balance is this. Do not put anything else in there, but you could bring this to the UK without any tax charge. On all the other accounts, if it's income, it could be up to 45% tax charge, gains 28%, or it could be mixed. So if it had a bit of income, a bit of gains, then overall it may be a blended rate. But it is the best time to create clean capital and to review the position is before you become UK resident. So ideally, we would advise before they come to the UK.
Right, thanks. So actually, the moral story is like to either do this before you arrive, or arrive in the winter time, so you potentially not become a UK tax resident for the first few months you're in the UK, but you do suffer this gloomy UK winter weather for a few months. There's a price to pay.
Yes. But if anything that we've learned is that we are able to advise our clients, very well remotely. So I do have calls. The time difference can be a bit difficult, but I do have calls with clients in the Far East where we're able to advise and engage with them and do all this planning without them needing to come and see us in the UK.
Yeah, that's not too bad. The timing, it's like we're 7 or 8 hours ahead of you guys, so it's not too bad to arrange for calls. So.
It's a very early start for me, yes.
Yeah, very early start for you, but normally I have like late call in Hong Kong, so fairly okay for my clients in the UK. They can have a lie in before they take the call to me. Anyway. So the other question I have is like the remittance basis. You say you can choose the years to kind of like qualify for the RBC. Remittance basis, claiming the remittance basis. So like, so you don't need to do consecutively. Like out of the first 6 years or 7 years, I can choose, like, if this year might be, okay, this first year I bring in 2 million, then to fund my lifestyle, whatever. And then next year I probably bring in nothing because I have enough money to park in the UK bank account. So maybe next year I hardly bring any money in. So do I then, I choose the remittance, so I stop choosing the remittance basis for the second year and go for a rising basis. Then I can go the third year, I need some money, I go back to remittance basis. Can it be done like that?
Not quite, William. So when you have funds that are not taxable in the UK under the remittance basis, those funds effectively, they are marked with that. So even if you stop claiming the remittance basis in the future and then bring it in, there may be a tax charge on it. So not claiming the remittance basis doesn't mean you can just bring in any funds. So that doesn't work. However, we do help our clients have a look on a year-on-year basis for the remittance basis. The reason for that is sometimes a client basically makes a large disposal of most of their offshore interests, and they just have a lot of funds offshore now. If that doesn't generate much income and there's no potential future gains, then that means, you know, for the rest of that year and the subsequent tax year, they may have very little offshore tax exposure in the UK. If they've been in the UK for 13 consecutive years, then we do a calculation to see, is it worth you being on a remittance basis and you have to pay £60,000 extra tax just for claiming it? Or is it better that in that year we do a calculation and we work out, if you didn't claim the remittance basis, what your UK tax exposure would be? So we do that. And often clients do have, you know, quite interesting scenarios where they sell a business and then they don't need the remittance basis for a few years, but then they create another business, or they have bought another income generating asset, or they may have another large disposal in the future year, so then they go back on the remittance basis. You know, every client, their scenarios are quite unique, so we do need to have a look each tax year, but it is possible to choose which tax year you want to do the remittance basis in. The only thing is you can't go back in the past and keep changing it from one side to the other. So there's a limit on what we can do if the tax year is already passed.
Right. Okay. That's clear, but that's so complicated. Yes, I still. So
yes,
you be careful how you bring your money in. Someone have a question here. I think there's already talk about whether this person have actually already bought a UK property as investment before. So while he's in Hong Kong, he bought the UK property a few years ago and getting rental income. Now he's actually thinking of moving to the UK for good. So obviously the rental income will be taxable in the UK anyway. So whether he's in Hong Kong or in the UK. So I think the question here is whether the money that he actually brought into the UK previously before he arrived as a either on an investor visa or whatever route he choose, does it need to be taxed, the capital that he brought into the UK prior to his arrival? I think that's the question.
Yeah. So in that instance, it just would depend on whether this individual had been UK resident in the past, if they've claimed the remittance base in the past. But if they've never come to the UK and they've bought a UK property and is rented out and is let out, and then subsequently they come to UK, the original funds they brought to UK to buy that property shouldn't be subject to any tax at that point.
Right. Okay. So that's fairly clear. And also the property gain, the capital gain on it has actually a cut-off date a few years ago. I can't remember what year they started.
Yes.
Prior to 2019 or something, or 2018.
Yes. So depending on what kind of property it is, if they've had it, let's say, for the last 20 years, then if they then dispose of it, they don't need to pay 20 years of gains in the UK. It may be rebased so that it's only the gains from 2015 onwards or 2019 onwards, depending on what kind of asset it is.
Yeah. Okay. I don't think there's any more questions. I've got any more questions. One other thing is, like, although I noticed this few years, the UK have lowered the corporate income tax rate.
Yes.
So a lot of people think that it's not too bad to have a company being brought in the tax net of the UK. Now you're at 19 and allegedly you may go down to 17. And Hong Kong still taxed at 16.5%, although you get this like first 2 million Hong Kong dollars taxed at 8.25%. But still, it's like the tax rate for corporate tax rate are fairly similar. So a lot of people are thinking that, oh, so it's not too bad. With like the husband and wife manager company while they're in the UK. I think that's the main point here. It's not the in my view, it's not the corporate income tax, because you can claim offshore in Hong Kong, not pay Hong Kong tax because you manage and control in the UK. You end up paying the UK tax. You might think that's no big deal because the tax rate is similar. But I think the main thing is like when you dispose of the company or other, when you get dividend income and things like that, you might be subject to tax in the UK, right?
Yes, especially if it is brought into UK, yes. So I think in that scenario, it's just important to know about the future plans and just examine if it is brought into UK tax net. So at the moment, the UK corporation tax is 19%. There was a time where it was going to reduce to 17%, but that's now been stopped. So for the time being, it's at 19%. And then it just depends on what they need to get out of the company. But typically, quite a few clients prefer to keep their offshore structures. The important thing here in terms of the offshore structures is that before they become deemed domiciled in the UK for inheritance tax purposes, the offshore company won't be caught within the UK inheritance tax until they're deemed domiciled. So for most of my clients, they don't become deemed domiciled. However, if that company then becomes a UK company, it may be subject to UK inheritance tax if someone passes away, unfortunately, and then you're looking at potentially 40% tax on that value, which obviously is quite significant. So we do need to think about mitigating the risk of that tax as well.
Well, okay, thank you. I don't believe there's any other people have any questions about. I think that your presentation actually answer a lot of like questions. I think the main point is like you definitely need to plan how you divide your capital, before you actually get into the UK. I mean, obviously, you have like sustain your lifestyle in the UK, and unless you are investing a lot in the UK and generate a lot UK source income and tax in the UK, otherwise, with the money you're going to potentially bring in the UK, you have to be careful. Otherwise, you end up like losing a big chunk of it to HMRC, and that's not really a good idea. And that's the part we'll come in to help you to sort out, segregate your capital prior to arrival, and then you can still maintain your lifestyle without actually suffering a lot of tax in the UK. Okay, without that, I think that's that concludes our webinar for today. And thanks everyone for joining this webinar.